And another thing about gold, if you go back to the last 50 years since it was legalized in the U.S., you've had two bull markets that were eightfold, bear low to bull high, with 4,200. You go about mid 8,000 area and you can say, oh, I've at least matched the two prior bull markets in terms of dimensionality. But within the monetary metals, silver is going to lead gold, is our argument. And I have certain expectations of silver that are rough. But at minimum, I think you could see $200 silver in the next 6 months or so.
Let's, for a thought experiment, say that silver gets to $70 in the next week. And it's Friday and it's almost the close of the market and somebody bids 75. But it's for one lot, it's for one contract, and it gets accepted.
Veteran analysts Michaeloliver and David Morgan outline why the current precious metals cycle is far from over. Gold's advance toward the $4,200 level places it midway through what they view as a classic multi-year expansion, one that could mirror previous eightfold bull markets and ultimately drive gold into the mid-$8,000 zone before this cycle exhausts itself. Yet within the monetary metal space, the expectation is that silver will outperform dramatically. Structural tightness, accelerating investment flows, and the speed of recent moves suggest silver could lunge toward $200 far sooner than most anticipate. They explore a scenario in which silver jumps to $70, then surges again on a thin end-of-week bid, highlighting how fragile market liquidity becomes during explosive repricings. In such moments, a single contract can set a new benchmark, signaling the start of price discovery in an overstretched system. If you found this analysis helpful, make sure to hit that like button, share it with fellow investors who follow gold and silver, and subscribe so you don't miss the next big update.
Yeah, well, what you're looking at is a spread chart. Meaning I divide an ounce of gold. I use the front month active COMEX future. Right now, that'd be the February 26th contract. December's in delivery, so we rotate to the Feb. So the February gold contract, which right now is 42.40, I think. But last month, these are monthly closes you're looking at. Plotted, what's the price of gold expressed as a percent of the price of the S&P? You just simply plot those charts every month. Here we go back to 2013, and that was the year in which gold, after the 2011 high, really started to implode in 2013. And naturally, its relative performance to the S&P, this spread chart, was in collapse mode as well. Okay. And by the time you got to late 2015, that spread dropped down to about 50%. That's on the left side of that chart, first low, just above 50. And gold at that point, if you draw a line sideways from late 2015 on this spread chart, you'll notice it's been above and below that level, zigzagging for 10 years. So almost you could say gold's been par to the S&P in terms of performance. Sometimes better, sometimes worse, but net on balance at that, let's say that low in 2015 at about 51%. It's, been either side of it. So you could have flipped the coin back in 2015 and bought gold or bought the S&P. And for most of those years, you'd be making money or losing money or making money, nothing in other words, okay? Right now, what's happened is that close in November took out a 1, 2, 3, 4-point trend line, almost flat, across every single rally high in that spread going back to 2014 rally, in late 2014, this first peak. That is a beautiful trend line. If this were a price chart of ABC stock and you broke out over that line and you were looking at the price chart, what would you say? Oh, we have a breakout. I got to buy that thing, okay? This is a fresh breakout. What it's saying is, yeah, we've seen strength in gold since early, 2024, actually. You can see it spread went from 40% up to 60%. But it's only just now broken out. So this game is really just beginning, the movement of money into gold, monetary metals, and out of the stock market. When you get this kind of breakout, and its momentum has also done the same thing, except earlier, it's saying something big. It's saying this is a monstrous base of monetary metals holding their ground versus the paper bubble. Everybody's cheering the stock market for the last 10 years, but nobody's noticing that you could have flipped the coin every 6 months and either been ahead or behind in gold relative to the stock market, but basically net sideways, meaning as well as the S&P. Nobody notices that. And I love that because they notice it later, But anyway, this is a breakout and it indicates something. You're not going up for 2-3 months here. This is going up for a couple of years and God knows where it's going. But this is a massive base that will have a massive move, and it just began. So people who look at a gold chart and say, oh my gosh, that's so steep, it's gained so much ground, they need to step back a bit. And another thing about gold, if you go back to the last 50 years since it was legalized in the U.S., you had two bull markets that were eightfold, bear low to bull high. 1976 bear low to 1980 high, 2001 to 2011. Both were eightfold dimension gains from low to high. We're only fourfold. Our low was 1,050. We're 4,200. You go about mid 8,000 area and you can say, oh, I've at least matched the two prior bull markets in terms of dimensionality. So even on that metric, gold is hardly overdone. The top chart is back to 2020. Silver versus gold. You divide an ounce of silver into an ounce of gold, express it as a percent. And back then we were under 1% in early 2020. And it exploded to 1.5% in a matter of a year. That was during that 2020 surge in the monetary metals. Gold went up 40%, silver doubled. So the spread increased. After that, silver, though going up in price mostly, had an erosional backing off on the performance. And it developed a downtrend and also a green horizontal ceiling. It blew through both last month. It's fully broken out of a massive base that goes back to 2021 on that green line, which is the most important. So not only are the monetary metals now going to beat the S&P, but within the monetary metals, silver is going to lead gold, is our argument. And I have certain expectations of silver that are rough, but at minimum, I think you could see $200 silver in the next 6 months or so. If you take this one back 50 years, everybody looks at the ratio scale. Fine, it's fine. It's just an upside down version of this. The bull market in 79.80 took silver to 6.5% of the price of gold. Okay, the bull market in 2010-11, when silver hit $50 again, was at 3.5%. Right now, this chart is not up to date. Right now, we're pushing up toward 1.4%. But even 1.4 to go up to 3.5, which it was during the last bull market, is a huge gain. It's almost tripling in the relative value of silver to gold. God forbid you go to the 1980 peak reading, which would have 6.5% the price of gold. And silver's not going up, by the way, and gold's sitting still. So as we're measuring silver relative to gold, we're measuring silver versus another rising market as well. So it's kind of hard to tell. We think this spread is likely to go in this surge up to at least 3%, meaning silver should at least double and a half. And once the spread breaks out, by the way, which it has just now, silver gold, you go back to 79, you'll see a similar incident in the summer of 79. 5 months later, silver quadrupled, almost quintupled. 5 months. 2010 to 11. The last 7 months of that bull trend, silver doubled in a half in 7 months in net price.
Michaeloliver outlines why the metals market has only just entered its actual expansion phase. His spread work, gold measured against the S&P, shows a decisive breakout from a decade-long base, signaling not a short-term rally but a multi-year rotation from equities into monetary metals. Gold's fourfold rise from its $1,050 low places it only halfway through the kind of eightfold advances seen in prior bull cycles, while silver's relative strength has already broken through multi-year resistance. Oliver notes that silver historically accelerates after these spread breakouts, doubling, tripling, or more within months, even while gold itself is rising. With structural pressure building beneath both metals, he argues this move is only in its opening chapter. Let's get into the interview.
Several years ago, I was asked by Futures Magazine to write an article on silver, and it was a bit of an honor, really, because most of them have to be CMTs or whatever, certified market technicians. I'm not very well versed in technical analysis, but they titled the article Spiked, and then the subtitle is something about silver. But silver has a propensity to spike low and spike high. And of course, anyone that looks at that cup and handle that's been referred to ad nauseum in the silver community, which is true, it's a huge cup and handle, and it is the most powerful formation. But the point is that if you look at it, you see these big spikes, spike in 1980, spike in 2011, and now we are spiking again. And in the article, I pointed out that when you get a parabolic move like that, it goes more or less straight up, often referred to as the hockey stick. To reiterate what you just said, be careful what you wish for, because it is telling us, and it doesn't matter if it's silver, soybeans, soybean oil, whatever it is, a stock, it is going to correct very rapidly as well. And the end is nigh. Nothing can grow straight up and then not come down at some point. I think, to answer the question, that we will back off. We're backing off today as we're doing the interview. And I think we will build what's the most powerful formation to maintain a higher price, which is kind of a stair-step configuration. You go up, go sideways, maybe somewhat down a step or two, and then level off, and then back up, and then level off. And if you go up in that manner, you're building a base all the way up. So you have conviction on the buy side and the sell side, but you have conviction in the market. Whereas it just keeps going up and up. You know, it's the last bid that makes the market. So what some people don't understand about a market, stocks, bonds, commodities, whatever. It's the last bid that shows up on the print at the end of the day. So let's, for a thought experiment, say that silver gets to $70 in the next week. And it's Friday and it's almost the close of the market and somebody bids 75, but it's for one lot, it's for one contract, and it gets accepted. Well, everyone that owns silver would look at that and say, my goodness, silver's at 75. Well, the paper price is at 75 and there's only one contract. One contract is not substantial, I mean, someone could come in and say, all right, I want to sell, and no one wants to buy it at 75. So the orders have to match. So the open orders at 71. And so that $4 difference gets gapped. In other words, the orders have to match. So there's a gap between the 75 and the 71. I hope I'm making sense here. But what I'm trying to point out is that in a runaway or straight up market, there's no stability. There's no foundation. There's no base. And that's why it could go down as quickly or usually quicker than it goes up. So I think I answered that sufficiently. I think we're going to be okay. I do see the end of the market like that, Elijah. It's almost inevitable because all markets get that blow off. If you look at the psychological aspect, there's a curve out there. I don't have it handy, but look at the stealth phase, the institutional phase, the smart money phase, and then it starts going parabolic, and that's the public phase. And then at the top, it says manic panic phase. In other words, gold could not shoot up alone without, and be in a true new bull market without confirmation from silver and really from platinum palladium. Well, that's taken place. So there's confirmation across the board that the metals move as a group in a strong bull market, and they are moving as a. The second thing is that silver will outperform at some point, and that, of course, took some time, as we both know, but it's not unusual for silver to play catch up once this new phase of the market happens. And my magic number was 70-1 on the gold silver ratio. And I think we were at 72 or 3 yesterday, but we've started to move down from that over 100 we were a few months back. And so we are intact for a new bull market. I think it's up and away. Hopefully it's a base and build with some massive corrections along the way. And I'll just give you a bit of a hint from my latest newsletter, my paid service, Elijah. And I put in there that I saw perhaps that we could get below the 4,000 level in gold again, and we could get below the $50 level in silver again. And I did not get too much pushback from my readers, but I did get some. And my take on that possibility is that on the metals alone, in the dynamics that we're sitting in today, if the status quo stayed as it is, and it never does, everything changes, probably wouldn't see under 50 or under 4,000 for gold and silver respect. However, if we were to get a large sell-off in the equity market, the S&P 500, and it was significant enough, I could definitely see the metals getting under those support levels. And that's what I think is going to happen. Now, I've been wrong for too long, but it doesn't mean I'm wrong forever. But it's the stop clock. A stop clock is correct twice a day. But anyway, not beating myself up too much. I do think that we will see a stock market correction. The metals will go down with it temporarily. It will be a buying opportunity. But the new bulls, the people that bought at 50 plus, watch it go to 60 and are in profit zone, and then to, not have a stop or whatever. I'm talking more for traders, but investors as well. I mean, if you buy it at 50, you pay a low premium, you buy a bag, and then the market's at, 45 again. You get a little disheartened, especially if you're a new buyer. Again, I don't want to make a big thing about it, but I don't rule it out on those conditions. I don't see it happening again. We continue as is, but I don't think we will. I think that, you look at the high tech and the NVIDIAs, how the Dow Jones and particularly the S&P 500 are weighted so heavily to make a construct that is really not showing the true broad width and depth of the S&P 500. You take 7 of the most popular, most liquid, and most traded stocks, and you base and weight the average upon that. It's really not telling the total truth. So I'm just making my case again that a stock market correction in my mind is well overdue. And I don't think I think it is out there in the future. Not necessarily. It, could keep going up.
David Morgan outlines why silver's structural behavior, its violent spikes and rapid reversals, reflects both its scarcity and its emotional market psychology. He notes that today's breakout mirrors past episodes such as 1980 and 2011, where parabolic moves signaled powerful trends but also warned of equally sharp corrections. Morgan emphasizes that the healthiest long-term advances are built through stair-step rises, where each consolidation forms a more substantial base. This pattern, along with confirmation across gold, silver, and the broader metals complex, supports the case for a sustained secular bull. While temporary pullbacks remain possible, especially if a broader equity market decline emerges, the underlying setup still points to higher highs and renewed leadership from silver as the gold-silver ratio continues tightening. For long-term investors, any volatility ahead may ultimately present an opportunity. If this gave you value, smash that like button, share it with those paying attention, and subscribe so you don't miss what's coming next. Stay alert, stay prepared, and keep stacking tangible assets.